Welcome to Valuations and Succession Planning for Car Dealers, where two industry experts take a deep dive into the world of dealership valuations and the strategies that can drive growth and success. In this series, Dan Iosue, a succession planner with the Rawls Group, and Scott Womack, Senior Vice President of Mercer Capital, will cover a wide range of topics, including the fundamentals of valuations, industry trends, best practices, and common challenges faced by car dealers. Here we go.
There's a little more gray area in more of a, when it's in the succession planning standpoint, or what, we would say is the, beginning or transition of ownership to the next generation, and we often work to separate the transition of control from the transition of ownership from an estate planning perspective, so that we can begin to shift, assets outside of a taxable estate while retaining control. And for most of our clients, and certainly in automotive, a significant part of their balance sheet, of course, is their dealerships. So valuations are critical, for that process. And as far as timing, we look to work that the valuation as close in timing as we can to the consummation of the transfer. Right. So if we're going to gift some non-voting shares, to a couple of kids or next generation that are, working in the business and have earned the opportunity for ownership, and we know we're going to do that, this year. In fact, we've got a client I'm working with at the moment where we've got three kids I say kids, they're adults in the next generation. They've each been working in the dealerships for over 10 years, and as part of the succession planning process, we're ready to, and the owner's ready to transfer 15% of 3 dealerships to the kids. So we just initiated having some valuations done, and we'll look to work with their CPA on appropriate discounts from estate planning perspective. But as far as the timing goes, the timing is now, and we're looking to consummate the in this case, it's a combination gift and purchase. So the next generation, we're going to want to get that accomplished within this tax year and have the valuation done within this tax year as well. So I think Scott, I'd be interested to know too, from your standpoint and experience. To me, I default to an expert like Scott as far as the specific timing and comfortability with, we're going to date this in January 1. Where within the tax year, does it have to be within the tax year? Those kinds of specifics and technical direction, we'd look to an expert like Scott for sure.
Yeah, and I love this question, right? It's all a matter of perspective. I think Dan makes some excellent points about, when you're ready, probably makes sense for a triggering event such as wealth transfer, succession planning. Other triggering events like, divorce, litigation, death of a shareholder sort of happen. And so the requirements and compliance elements of that kind of dictate when the valuations need to be done. So selfishly, I'll always tell you sooner than later from our perspective. To Dan's point, the valuation is usually tied to a specific event. So the data valuation is important. Valuations for operating businesses such as auto dealers are dynamic, they're volatile, and so they're a point in time estimate. So you wouldn't want to have a large time lapse between the contemplated triggering event and either the data valuation or when the valuation is performed. Give an example, divorce is a great context where this comes to fruition. In states where you go to trial, a lot of states are what we call current value states. So you want the value of the dealership as current as possible. And to the extent these divorce cases get prolonged, don't settle, oftentimes we have cases where we have to revalue the business, right? Because the value can change over time. So selfishly, I would say sooner than later. There's some other kind of key things, just from a strategic planning standpoint, you might think about if you just, retained a new general manager when we talk about buy-sell agreements and sort of incentivizing them. You might want to do it on the front end. Perhaps if you've added a rooftop on to your operations, might be a good opportunity to assess sort of where you are at. And then when you think about, planning goals, strategic planning, it's a good measure of value. So it depends, but I will always selfishly default to sooner rather than later.
This is only one out of our 12-episode series focused on dealership valuations and the strategies that can drive growth and success. Continue listening to the series now or come back for more. Each topic featured may want you to learn something new. Succession planning allows you to create more control over the future you envision by proactively addressing possible, probable, and potential issues impacting your goals. Do you have a question you want to discuss with an expert? Feel free to reach out directly to Dan or Scott at the email addresses listed on the screen. Valuations and Succession Planning for Car Dealers is a part of the Rawls Group's Advancing Your Business, People, and Legacy Conversation series.